Guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday, the 29th of November to Friday, the 3rd of December, 2021. Can't believe we are heading towards December already. But anyway, jumping straight into it, our main focus this week will be on the US dollar. Now, the dollar has recently lived up to its normal title, King Dollar. Massive amount of outperformance for the greenback versus most of the other majors over the past couple of weeks. If we take a look at this handy chart from Refinitiv, it shows that the dollar basically outperformed 31 of the 36 currencies listed year to date. Now, I think what's very interesting here is just to remind everyone that going into the end of last year, the end of 2020, the majority of market participants expected the dollar to continue weakening throughout the whole 2021. Now, where we are right now, it's the complete opposite. We're going into the end of 2021, and majority of market participants expect the dollar to continue rallying throughout the whole of 2022. Now, don't take this as me calling for dollar weakness throughout the whole of next year. There's just way too many variables in the mix right now to give a solid bias for where the dollar is going to be throughout the whole of next year. But I do think this is a really good reminder of just how wrong consensus can be at times and why we often need to take full year views of a specific currency with a very, very big pinch of salt. Now, turning our attention to Friday's session, of course, we had overall risk appetite that took a massive nosedive on Friday. If we take a look at this snapshot, looking at these numbers for equity futures pushing to the downside, some of them like IBEX down over 5%, big moves. If we take a look at the Russell futures down over 4%. Taking a look at light crude, I mean, WTI down almost 12%, guys. Really big risk of tilt on Friday. And that, of course, came on the back of fears of the new COVID variant called Omicron. Now, it was first expected to be named the new variant. Now it's Omicron. But basically, that was the main reason why risk assets took a little bit of a tumble. Investors ran for the exits in terms of risk assets and saw solid demand, of course, playing out for safe havens like the Japanese yen, the Swiss franc, for bonds across the board, all except one safe haven, which is, of course, the US dollar. The dollar continued to push lower throughout the session. Now, the reason for the confusion for some participants about the dollar pushing low in that environment is, of course, because the dollar is a safe haven. So usually you would expect the dollar to strengthen on the back of a risk-off environment. But that, of course, wasn't the case. Now, luckily, we were well prepared for that type of outcome, as both positioning as well as Fed policy expectations, left the dollar vulnerable even before we went into that risk-off session. Now, in terms of Fed policy alone, I think this chart speaks volumes. On the left-hand side, we have Fed Fund futures on Thursday evening. And on the right-hand side, we have the same chart, but looking at the end of day on Friday. Now, recall that before the COVID scare surfaced on Friday, markets were pricing in 3 hikes for the Fed next year, 1 June, 1 September, 1 December. And also, consider that a faster taper was very fast becoming consensus due to the comments we had from the likes of Clarida, the comments we had from Daily. So by the early part of Friday, markets had already priced out one of those 3 hikes previously priced for 2022. And obviously, doubts started to resurface on the tapering side, whether the Fed will want to move faster with tapering with this new emergence of this COVID variant. Now, we were getting cautious of a potential, peak hawkishness in the short term for the dollar running into the December Fed meeting. So an unwind of those expectations, clearly seen in Fed Fund futures, was expected to see some downside in the dollar, as we noted not only on Friday, but also, throughout the last couple of trading sessions. Now, before we get to the second aspect, which is positioning, there were a bunch of other aspects also pointing to possible dollar downside. The first one, of course, came in the back of FX implied volatility, which pointed to possible softness playing out for the dollar. But of course, we got the COVID scare, and that started to see FX implied vols jolting back to the upside. So even though we expected downside for the dollar, going into Thursday's session, what we saw on Friday basically counteracted that in terms of FX implied volatility. Apart from that, there's also global economic data. In this chart, we've got the economic surprise index for global economic data in orange. We've got the dollar index in blue, and normally we have an inverse correlation to global economic surprises in the data and the US dollar. So the fact that that has been pushing to the upside is something that for us, did mean that we could expect some downside for the dollar as it started to confirm a possible, reflationary environment going into the latter part of the year. That was also something that we were looking at. There was also things like seasonality, which still does point to possible downside playing out for the US dollar. And we were also looking at the technical picture, which was setting up for possible downside as well. We saw that upward momentum that we saw in the short term was starting to run out of a little bit of steam, looking at that rate of change indicator, and also a classic, bearish divergence playing out on the H4. So there was a couple of reasons why we were expecting some downside. But again, the fact that the markets were expecting upside for the dollar from a risk-off environment, that wasn't really the surprise. What was the surprise was that nobody was focusing on the massive amount of unwinding that needed to take place in Fed fund futures, and of course, taking a look at positioning. I think that's a very important one to keep in mind. Apart from the dollar, which has been very, very bullish position from a large speculator point of view, I think the even more important one, the one that we were looking at in Thursday already for some potential dollar yen downside, was the yen positioning. If you take a look at yen positioning for both the large speculators as well as leverage funds, they've been stretched for a while now, looking at some very, very interesting mean reversion possibilities. So, any strong bouts of risk-off sentiment was always expected to see the yen outperform its safe haven peer, the US dollar, at least in the short term, as positioning, recalibrated. Now, apart from that, the accompanying push lower, I think in yields, across the curve, if we take a look at twos, take a look at tens, that also provided additional support for the Japanese yen. Remember that the Japanese yen normally moves inversely correlated to US yields, more so correlated to US 10-year compared to that of US 2-year. Obviously, the context is always important. Sometimes the twos might be more important. Sometimes the tens might be more important. But if you take a look at a longer period, normally it's tens over twos. So that's something to also keep in mind. Now, the question right now then for the dollar is whether the softness, do we expect it to continue? For now, there's no easy answers. I think there's a lot of moving parts right now, but our base case is for further softness as the markets tone down Fed policy expectations. But again, there's lots of moving parts right now. I think the first one on the radar for the next week will, of course, be the virus situation, right? If we have further bad news about the transmissibility of this new variant, if we have further bad news about the fatality rate or potential fatality rate, if we have further bad news about the effectiveness of our current vaccines against this, that's going to be very, very important news for the markets to watch. Just some additional information on that before we continue. There was some good news on that front over the weekend because the word on the ground from doctors at the epicenter in South Africa has over the weekend said that even though cases are on the rise, if you take a look at new cases, up more than 3,000, which is quite a big jump, even though that's the case, so far the symptoms reported from the new variant has been mild compared to that of Delta. Now, of course, it's still very early days, but for now, at least, South African doctors are calling the reaction from the rest of the world a massive overreaction, saying that right now there just isn't any reason to panic, but also, added that in the next 2 weeks' time, maybe they say something completely different. But I think for now, that is slightly positive news. Also, just to put it into context, cases for this virus has now been detected in Hong Kong, Australia, Belgium, Italy, Germany, UK, Austria, Denmark, Israel. So it's not, it's everywhere, and that is something to keep in mind. Now, what we need to think about in terms of what this means for the dollar is if we get bad news again, either about the transmissibility, about the fatality of the variant, the effectiveness of the current vaccinations. If there's bad news, that should keep Fed officials cautious, and they will likely push back expectations for a faster taper. But if markets fail to if markets completely fall off a cliff and risk assets continue to push lower, if it happens far enough and liquidity becomes a big problem, then obviously the dollar should catch a solid safe haven bid. So it's a little bit of a mixed bag between those two, and something that we do need to keep in mind. Apart from that, we've got some solid economic data, big bunch of economic data coming out for the US next week. We've got the ISM reports. We've got, of course, NFP coming up on Friday. Now, if we have any major big upside surprises in these data points, that could spark further dollar upside, I think, in the short term at least, because it will provide further evidence for the Fed that the economy is strong enough to potentially speed up tapering, despite what's happening on the virus front. But of course, maybe virus concerns get so big in the week ahead that it gets big enough to overshadow the economic data. Obviously, we'll get a better sense of how the market opens up on Monday, how it trades throughout the session. That'll give us a good idea of how fast the market is coming to grips with this new variant. Again, if we can see some calm restored and we get solid economic data, maybe the Fed just brushes aside these concerns, and that's definitely something we'll need to pay attention to. The other market we'll be watching for the dollar is, of course, inflation expectations. We can see 1-year break-even inflation expectations here in blue, the 5-year in pink or purple. We've got the 10-year in orange. Now, how will the virus fears and lockdown news affect inflation expectations? That's a very important question, because right now the Fed is spooked by inflation, right? Virus fears already saw some concerns of demand destruction, pushing inflation expectations lower in Friday's session. Obviously, the move in oil had something to do with that as well. But think about what more lockdowns will mean. If we get more lockdowns and more stress about the virus, that also means potentially longer supply chain disruptions. And as we know, that's been a key concern for inflation pushing higher in the medium term over the course of this year. So that could potentially mean more sticky inflation, which is something we'll need to pay attention to. Apart from that, OPEC, I think, here plays a very important role. The cartel plays a very important role with the upcoming meeting. The downside we had in oil last week means that there is less stress on inflation expectations in the short term. And that, of course, should be a dollar negative, because if there's less stress about inflation, there's less reason for the Fed to move more aggressively when it comes to tapering. But if OPEC chooses to pause their planned output increases this week or this upcoming week, that could spark some recovery in oil prices, which, accompanied with now potential, again, longer lasting supply chain issues, that could once again spark further upside in inflation expectations, which means that oil upside this week could counterintuitively actually be a dollar positive if it plays out in terms of inflation expectations. So inflation expectations coupled with OPEC, very important concepts that we'll be looking at in the week ahead when it comes to the US dollar. Apart from that, Fed speak. Fed speak is going to be very important. What the Fed has to say this week is going to be crucial for the dollar. Keep in mind that the Fed's blackout period for the December meeting, that starts on Friday, December the 3rd to December the 15th. So if the Fed, suddenly changed their minds about potentially upping the pace of tapering. Remember, we had the comments coming out from Daly, the comments coming out from Clarida. We've got Fed Chair Powell coming up this week for his testimony. We also, of course, have a slew of central bank speakers coming up this week. So if they want to change their mind about anything they said recently, especially the likes of Clarida and Daly, this week's going to be the week for them to say that. So what the Fed has to say will be very important. If they see the threat of the new variant as being big enough to stay a little bit more patient, expect downside for the US dollar. But similarly, if they come out and they sound, very, very calm, if Fed Chair Powell says that, the variant, yes, it's a concern, but that's not really going to change or potentially change the policy outlook, expect upside for the US dollar. Now, in terms of all of this, I think right now, the dollar yen remains a very interesting pair. As you guys know, we went short dollar yen on the COVID news. We had a great trade. I mean, the trade paid out well so far with that push to the downside on Friday. I think right now the pair could be a very well-suited hedge against the Fed. Now, let me explain why. I think it can be a good hedge against a more aggressive Fed as well as a more patient Fed. So basically, whatever the Fed decides, I think dollar yen could be a great hedge to the downside. For example, if we get a patient Fed, right, that's going to mean downside across the curve for bond yields, whether it's 2s or 5s or 10s. And as you guys know, downside in yields is normally a positive input when it comes to the Japanese yen. And obviously, that should mean downside for dollar yen. Well, if we get an aggressive Fed, so let's say this week they come out saying that, you know what, even in the midst of this virus, we're not too concerned about the virus. We are more concerned about inflation. We're going to act aggressively, or expect us to act more aggressively. Even though that should see dollar upside, and that of course can see dollar yen upside, we do need to keep in mind what that type of response will mean for the curve. If we see that type of response coming out of the Fed, arguably that's going to lead to a much flatter yield curve, i.e., tens outperforming or twos outperforming tens. And if we see that curve dropping to the downside, that basically sparking some medium-term demand destruction expectations, we can expect the Japanese yen to be favored in that environment. And again, as a hedge, I think dollar yen to the downside is very, very interesting here, and something that I'll be looking to hold short. Obviously depending on what the information brings this week, but I do think in either scenario, dollar yen could be interesting. Downside expected if the Fed stays patient, and less downside, more range bound price action expected if they come out a little bit more aggressive. The other one that I think is interesting here to watch in the week ahead is Euro Kiwi. Now, obviously, we had a big push to the upside. The Kiwi was weak before the COVID news because the markets, pushed the Kiwi lower because the RBNZ came out with just that 25 basis point hike instead of a 50, as some of the bulls had expected or hoped for. We do think that the downside has been a little bit overdone, even before the COVID news. Obviously, with COVID news, we saw a lot of downside in the high betas, and we saw some carry unwinding taking place in the euro, pushing euro to the upside. So it was a double whammy for Euro Kiwi. But where I think Euro Kiwi could be interesting is if we do see total calm this week in markets, if markets get over this variant a lot quicker, or very quickly, I think Euro Kiwi downside can be very interesting. For now, it's something I'm playing a little bit more patient. I want to see how the market reacts on the open on Monday. I want to see how risk assets trade. There has been some participants coming out over the weekend with research notes saying that they're not as confident in the buy the dip mentality this time around as they were a couple of months ago, because they're saying we're going into the last quarter or the last month of the year. So imagine that you are up, a healthy whatever, let's just say it's 20 or 30% on your equity portfolio. Maybe this is a good time for you to bank some of those profits, to book some of those gains, and not allow the markets to take it away from you in the last couple of weeks due to a new variant. So some is saying there's maybe a little bit more caution coming into the markets in terms of buy the dip. So let's just be a little bit more patient. But if we do see the markets getting over this thing a little bit quicker, I think Euro Kiwi downside could also be interesting in the week ahead. But again, let's wait and see what happens with overall risk sentiment and how the markets trade at the open, and how the market takes these new developments. All right, guys, so that's two key pairs that I'll be watching in the week ahead. As always, I hope you guys have a fantastic trading week. And any questions, don't hesitate to let us know.